Stocks are acting like they just discovered free dessert at an all-you-can-eat buffet. This past week, markets surged to fresh record highs after the Federal Reserve delivered its first rate cut of the year. The move set off what strategists are calling a honeymoon rally, where optimism is running wild and investors are treating every headline like good news. September usually has a reputation for being a rough month for stocks, but this time the market is ignoring history. Cheaper money and the ongoing boom in artificial intelligence have powered equities higher, creating a cocktail of excitement that feels more like a party than a cautious investment environment. Michael Hartnett of Bank of America added fuel to the optimism by pointing out that if this is a bubble, it may not be ready to burst. His team studied more than a century of market manias and found that bubbles typically deliver average gains of 244% from trough to peak. The so-called Magnificent Seven tech giants are already up to 123% since their March 2023 lows, which suggests that, in their words, there could still be room for stocks to climb higher. And here's the thing, cheaper money is flowing into the markets. Money keeps printing, and this acts as a tailwind for stocks, but also pushes up asset prices, including real estate. And according to BofA, when you look back in history at periods of cheap money, there's always been a boom that followed. And right now, we are seeing one of those booms. People call it the AI boom. It's not clear how long this party will last or if it will end in a burst of fireworks or a crash. But for now, the champagne is on ice and the music's playing. Jeff Krumpelman, chief investment strategist at Mariner Wealth Advisors, reinforced that view. He argued that AI-driven productivity gains and strong earnings prospects justify higher valuations. In his words, we're still in the very early innings of AI, and it's creating opportunities that are reshaping the economy. Yes, the S&P 500's valuation, about 23 times forward earnings, is high compared to history. But Krumpelman insists this isn't your grandfather's stock market. Back then, profit margins and returns on equity were far lower, and the economy wasn't dominated by technology and communication services the way it is today. Still, not everyone is ready to toast the rally. Krumpelman himself warned that a melt-up, where Investo, RS go overboard on enthusiasm, could make him nervous. Yardeni of Yardeni Research echoed that concern, suggesting that easier monetary policy could spark a destabilizing rally without fixing deeper issues like America's labor supply shortage. Cutting rates into a still healthy economy, he argued, risks fueling speculative excess driven by fear of missing out rather than fundamentals. Emily Roland of John Hancock Investment Management described the current environment as unusually favorable but fragile. She noted that the market seems to have selective hearing right now, tuning out risks and only focusing on the Fed's rate cuts. In her words, it almost feels like bad news is good news and good news is good news, because either way, investors assume the Fed will keep cutting. Meanwhile, Wall Street's biggest firms are leaning bullish. Wells Fargo, Barclays, and Deutsche Bank have all raised their S&P 500 targets, pointing to resilient earnings, the AI investment cycle, and easier Fed policy as reasons for more upside. But even the optimists admit there are risks. Citi, Fundstrat, and Evercore EC have warned that stretched valuations, weakening breadth, and rising tech volatility could make the near-term path bumpier, even if the longer-term AI-driven bull market stays intact. Bill Smead of Smead Capital Management drew a sharper warning, comparing today's AI enthusiasm to past periods of mania. He expects that at some point this bubble will break, and when it does, heartbreak will follow. With so much of the market concentrated in a handful of tech names, he argues, the risks are amplified. Right now, the stock market feels like a teenager in love. Everything is exciting. Nothing can go wrong, and AI is the prom queen. But honeymoons don't last forever. The question is whether this story ends with a happily ever after or a painful wake-up call. I think this is one of those times where the market is pricing imperfection. When you look at the Magnificent Seven, these are extremely large companies and they're growing fast. However, if you start to look for cracks in their growth story, you'll find them. And I think that when people realize that these stocks aren't actually perfect, that's when you're going to see a rotation out of these stocks. And that could lead to some serious downside. There's no doubt that AI is transforming our lives, but there's also no doubt that many companies are overhyped. Investors need to be extremely careful when investing in this space. If you invest in the right companies, you could make a lot of money. But if you invest in the wrong ones, you could lose a lot of money. Thanks for watching.